All right, so already talked about this. Accountants will recognize income for financial statement purposes when it's realized and when it's earned. So this is our accrual method of accounting. So realization, what exactly does that mean? So this is the process of converting a non-cash resource into cash or the right to cash when you actually realize that. Now we have this concept in tax as well, and we'll get into that here in just a minute. So again, this is kind of what we went through earlier. Income has been earned when companies or persons have performed all actions necessary to complete the transaction. We're recognizing revenue when it's earned. So when a grocery store sells you a can of beans, it has earned the income because it has done everything it needs to do to complete the transaction. The store does not need to open the can, keep the contents, and serve you at the dinner table. Now for tax purposes, we have 3 different conditions that have to be met in order to recognize income, okay? The first one is there has to be some sort of economic benefit, an economic benefit. Now, economic benefits don't always come in the form of cash. Sometimes they come in different forms, but there has to be some sort of economic benefit. So if a person, I'll show you an example here, if a person is economically better off as a result of a transaction, then they usually have to record income. Now, somebody gives you some cash, or you earn some cash through your wages, you've received an economic benefit from that, that's pretty easy. But there are other ways that you can get an economic benefit without actually receiving any cash. So, if they've got an example here, if an accountant performs some tax work for a client, and instead of paying the accountant for that tax work, the client gives the money, the $500, to a bank because the accountant had a debt to the bank. They give it to the bank, then the accountant no longer has that debt. They've received an economic benefit from that, even though they did not directly receive the cash, right? So in that case, income has actually been realized, even though, like I said, the accountant has not received the actual cash. If bartering is another example. So you're an accountant and you prepare taxes for, let's say, an attorney. You prepare those taxes for the attorney. In exchange, the attorney is going to file some paperwork for you, some incorporation paperwork, and do all that stuff, but there's no cash that's actually being exchanged. There still is income that has to be recorded because you've both received an economic benefit from it in the form of you didn't have to pay the cash out, right? So, and the economic benefit in that case is the value of whatever you received. So, as the CPA, my value is whatever the fee would have been from the attorney. The value to the attorney is whatever my fee would have been as a CPA. There's still an economic benefit there. Okay, just sort of another example of how that can happen without the actual exchange of cash. Also, number 2, does anybody have any questions about that? Okay. Second thing that has to happen, the transaction has to have reached a conclusion. Now, what exactly does that mean? First, the transaction has to occur. So it can't be something that is maybe going to occur in the future or is going to start at some point in the future. So for example, you have a contract, you're a contractor, you're fixing somebody's driveway, you have a signed contract from them, that's going to happen in the future. That transaction hasn't even started yet, right? You haven't started work yet on the driveway, they haven't given you any cash yet. So the transaction hasn't even occurred yet in that example. So the transaction has to occur. The second is that the transaction process has to be complete. It has to finish. They give an example here, and we're gonna run into this when we get to the chapter about capital gains. So, capital gains are when you purchase an asset and then you sell that asset. If it's a gain, you sell it for more than what you purchased it for, or what its basis is. That's a tax term, basis. Then you sell it for more than what its basis is, then you have a gain. If you sell it for less than what its basis is, or cost, in financial we use cost or book value, then we have a loss. Well, just the action of purchasing, so we'll go back to the stocks. We'll use the stock example that they have here. If you purchase some stocks, so the transaction has occurred, but it hasn't completed yet because you haven't sold it yet. You still hold it. Just because that stock has increased or decreased in value while you've held it doesn't mean that the transaction's still going on. It is ongoing at that point. It is not until the point that you sell that stock, either for a gain or a loss, that transaction has reached a conclusion. Does that make sense? Okay? So there's gotta be an economic benefit, and the transaction has to start and end. These seem pretty simple, right? The third thing is actually a negative. I don't mean negative as in bad, I mean it's a negative concept. The income cannot be tax exempt. There are certain types of income that Congress has deemed not subject to tax. Remember I said Congress says everything is taxable income unless they say it isn't. These are the items that they say aren't taxable income. Okay, so pretty simple. Those three things, those three conditions have to be met, and those are three things you have to ask yourself with any type of transaction. Is there an economic benefit? Not necessarily in cash, could be in some other form. Has the transaction occurred and reached a conclusion? And is the income tax exempt? So if any one of those things hasn't occurred, then we do not realize that income. It is not a taxable event yet. Okay? Any questions about that? All right.